Hello students, welcome to today's episode. In this episode, we will discuss about risk in capital budgeting. This topic is divided into two parts. The first part of the topic covers non-mathematical methods, which are also known as conventional techniques. And the second part of the topic covers mathematical or statistical techniques. I am Dr. Arshia Hussain, PhD in Human Resource Management and teaching in the Department of Commerce and Business Studies, Jamia Millia Islamia University, New Delhi. So, we will first discuss the meaning of risk in capital budgeting. Risk analysis in capital budgeting. Risk in the context of capital budgeting decision may be defined as the variability that is likely to occur in the expected future return in terms of cash flows from the investment. The greater the variability, more risky is the investment. Risk exists due to the inability of the decision maker to make perfect forecast about expected cash flows. Perfect forecast about expected cash flows cannot be made because all the possible future events on which forecasts depend can neither be anticipated nor be correctly predicted with accuracy. The factors influencing the forecast about cash flows are as follows. First one, world economic and political factors. Second one, national economic factors, for example, internal economic, political and social conditions, monetary and fiscal policies. Next is industrial factors such as industrial relations in the industry. Next is company factors such as strike in the company, change in management, natural disasters such as flood, fire, fraud and mismanagement in a company. Now, we will talk about risk versus uncertainty. See, there is a difference between risk and uncertainty. Risk refers to the situation where the probability distribution of the cash flows of an investment proposal is known, whereas uncertainty refers to the situation where the probability distribution of the cash flows of an investment proposal is not known due to lack of some historical data. However, these two terms are used interchangeably by many financial authors. There are two methods of incorporating risk in capital budgeting. The first one is non-mathematical methods, also known as conventional techniques. Under this, we have first one, risk-adjusted discount rate approach. The second one is certainty equivalent approach. Third one is sensitivity analysis. Then the next methods is mathematical methods, which are also known as statistical techniques. Under this, we will be dealing with probability distribution approach. Next is decision tree approach and simulation approach. So, in this episode, we will start with the first method, which is risk-adjusted discount rate approach. Risk-adjusted discount rate method is a method of adjusting the discount rate to reflect the project risk. If the risk of the project is equal to the risk of the existing investments of the firm, the discount rate used is the average cost of capital of the firm. If the risk of the project is greater than the risk of the existing investments of the firm, The discount rate used is higher than the average cost of capital of the firm. Finally, if the risk of the project is less than the risk of the existing investments of the firm, the discount rate used is less than the average cost of capital of the firm. In other words, the risk-adjusted discount rate approach incorporates the risk by varying the discount rate depending on the degree of risk of a project. A high discount rate is used for more risky project and lower discount rate is used for less risky project. The risk-adjusted discount rate is Rk is equal to I plus N plus Dk, where Rk is equal to risk adjusted discount rate for project K. I stands for risk free rate of interest. N stands for the adjustment for the firm's normal risk. And Dk stands for the adjustment for the differential risk of the project K. Now, it is important to mention here that I plus N measures the firm's cost of capital. Dk may be positive or negative depending on how the risk of the project under consideration compares with the existing risk of the firm. Now, we will see the accept or reject rule. The first one, accept the project if Npv is greater than 0. Reject the project if Npv is less than 0. If Npv is equal to 0, the management would be indifferent as to whether to accept or reject the project. Then accept the project if IRR is greater than risk adjusted minimum required rate of return. If IRR is less than risk adjusted minimum required rate of return, then reject the project. And finally, if IRR, that is internal rate of return, is equal to risk adjusted minimum required rate of return, the management would be indifferent as to whether to accept or reject the project. Now, let's see one illustration on this. Sigma Limited is considering one of the two mutually exclusive project A and project B, which require cash outlay of rupees 5 lakhs and rupees 7 lakhs respectively. The current yield on government bonds is 5%, which may be considered as risk-free rate. The risk premium is 3%. The expected net cash flows are as follows. Now, we can see the table year end. We can see that 3 years are given, year 1, year 2 and year 3. Cash flow of project A and cash flow of project B is also given. For project A, we have rupees 2 lakh in the first year, and for project B, we have 3 lakh in the first year. Then in the second year, we have rupees 3 lakh for project A. Then for project B, we have rupees 4 lakh. Then in the third year, we have rupees 4 lakh for project A, and for project B, we have rupees 5 lakhs. Now, which project should be accepted? Solution, we can see the statement showing Npv at risk adjusted rate of 8%, that is 5% plus 3%. We can see the table here. The years are given to us, PV factor at 8% is given to us, then project A and project B. Cash flows are given to us, and PV, that is present values, are also given to us. Now, we can see that for 0 year it is 1, cash flow for project A is minus 5 lakhs, present value is again minus 5 lakh. Then for project B we have minus 7 lakh, and the present value for project B is minus 7 lakh. Now, for the first year, the present value factor at 8% is 0.926, and the cash flow is 2 lakhs, and present value is 1,85,200. Then cash flow for project B is rupees 3 lakhs, and present value is 2,77,800. Then for the second year, the PV factor at 8% is 0.857, cash flow is 3 lakhs and present value is 2,57,100. Then cash flow for project B is 4 lakhs and present value is 3,42,800. Then for the third year, the PV factor at 8%, cash flow we can see is 4 lakhs, then present value is 3,17,600. Similarly, for project B, the cash flow is 5 lakhs and present value is 3,97,000. Now, the total of present values for project A is 2,59,900 and the total present values for the project B is 3,17,600. So, we can see that project B should be accepted since its net present value is higher than that of the project A. Now, we will see second method, which is certainty equivalent approach. Certainty equivalent approach is one of the risk analysis techniques under which risk is incorporated by discounting the riskless cash flows at risk-free rate. It incorporates the risk by converting the risky cash flows into riskless cash flows. In CE approach, the equivalent riskless cash flows are substituted for the expected cash flows. In other words, the expected cash flows are transformed into their certainty equivalent by applying suitable certainty equivalent coefficients. Then the risk-free interest is applied for discounting purposes. Now, certain riskless cash flow is equal to risky cash flow multiplied by certainty equivalent coefficient. Then certainty equivalent coefficient is equal to riskless cash flow divided by risky cash flow. Now, we will see one illustration on this. If risky cash flow is rupees 2 lakh and riskless cash flow is rupees 1,60,000, then certainty equivalent coefficient is equal to riskless cash flow divided by risky cash flow. So, we have 1,60,000 divided by 2 lakhs, that comes out to be 0.80. Now, we will see how to calculate NPV using certainty equivalent approach. So, calculation of NPV, that is net present value, by CE approach involves the following steps. First of all, future cash flows from the proposal are estimated. The calculated cash flows do have some degree of risk involved. Secondly, CE factors for different years are calculated. The CE factors reflect the proportion of the future cash flow that would be acceptable in exchange for the future cash flow. These CE factors represent the level of present money at which the firm would be indifferent between accepting the present money or future cash flow. Thirdly, the expected cash flows for different years are multiplied by the respective CE factors, and the figures obtained are known as certainty equivalent cash flows. The fourth step includes discounting the CE cash flows at risk-free rate to find out the NPV of the proposal. Now, we can see that risk adjusted net present value is equal to sigma CFI minus CO. Now, we will see the accept reject rule when NPV technique is used. First one, accept the project if NPV of certainty equivalent cash flow is greater than 0. Second one, equivalent cash flow, reject the proposal if NPV of certainty equivalent cash flow is less than 0. If net present value is equal to 0, the management would be indifferent as to whether to accept or reject the proposal. Now, accept or reject rule when internal rate of return, that is IRR technique, is used. First one, accept the project if IRR, which equates the present value of certainty equivalent cash flows with the present value of certainty equivalent cash outflow, is greater than minimum risk-free discount rate. Then reject the project if IRR is less than minimum risk-free discount rate. Accept or reject criteria for multiple mutually exclusive projects. When NPV technique is used, projects should be ranked in the order of NPV and the project with highest net present value should be selected. Then when IRR technique is used, then projects should be ranked in the order of IRR and the project with highest internal rate of return should be selected. Now we will see difference between risk adjusted discount rate and certainty equivalent approach. Risk adjusted discount rate, which is known as RAD rate, incorporates risk by adjusting discount rate, whereas certainty equivalent approach, that is CE, incorporates risk by adjusting cash flows. Second one, RAD rate approach uses risk adjusted discount rate, that is RAD is equal to risk free rate, which is equal to risk premium, whereas certainty equivalent approach uses risk free discount rate. The third difference is RAD uses risky cash flows, whereas certainty equivalent approach uses certain cash flows. Now we will see another illustration. X Limited is considering one of the two mutually exclusive project P and project Q, which require cash outlay of rupees 5 lakh and rupees 7 lakh respectively. The current yield on government bonds is 5%, which may be considered as risk-free rate. The risk premium is 3%. The expected net cash flows and their certainty equivalents are as follows. Now, the table for the illustration 2 we can see, which we have year's end for project A and for project B. So, 3 years are given to us, 1, 2 and 3, and the cash flows we can see are given to us, certainty equivalent we have with us. For cash flow we have rupees 2 lakhs and rupees 3 lakhs in the first and second year respectively, and in the third year we have 4 lakhs. Then certainty equivalent for project A in the first year is 0.9, in the second year it is 0.8, in the third year it is 0.7. Then for project B we can see cash flow is 3 lakhs in the first year, then 4 lakhs in the second year and 5 lakhs in the third year. Then certainty equivalent for project B is 0.8 in the first year for the cash flow of 3 lakhs, then 0.7 in the second year, then 0.6 in the third year. Now, what we are required to compute? We are required to calculate which project should be accepted. Then second, which project is riskier and why. And the third one, if risk adjusted discount rate is used, then which project would be appraised with a higher rate and why. Now we can see the solution here, statement showing NPV of project A. Years are given to us, cash flows we have, then certainty equivalent and adjusted cash flow is also given to us, then PV factor at 5%, and then finally we will have to calculate the present value. Now years are given to us 0, 1, 2, 3, and we have cash flow in 0 year is minus 5 lakhs, then certainty equivalent is 1, then adjusted cash flow is minus 5 lakhs, then PV factor at 5% is 1.000 and present value we have is minus 5 lakhs. Now in the first year it is 2 lakhs as cash flows, then certainty equivalent is 0.90, adjusted cash flow is 1,80,000, then PV factor at 5% is 0.952 and the present value is 1,71,360. Then for the second year we have cash flow 3 lakhs, then certainty equivalent is 0.80, adjusted cash flow is 2,40,000, PV factor at 5% is 0.907 and present value is 2,17,680. Then for the third year the cash flow is 4 lakhs, certainty equivalent is 0.70, cash adjusted flow or adjusted cash flow is 2,80,000, then PV factor at 5% is 0.864 and finally present value is 2,41,920. So the summation of all this gives us the net present value, which is equal to 1,30,960. Now we can see the statement which shows the NPV of project B. For project B, we have again the same number of years 0, 1, 2, 3 and cash flows we have. For the 0 year, it is minus 7 lakh. Certainty equivalent is 1. Adjusted cash flow is minus 7 lakhs. PV factor at 5% is 1. Then present value calculated is minus 7 lakhs. Then in the first year, we have 3 lakhs, certainty equivalent is 0.80, adjusted cash flow is 2,40,000, PV factor at 5% is 0.952 and present value is 2,28,480. Now, in the second year, we have cash flow as 4 lakhs, then certainty equivalent is 0.70, adjusted cash flow is 2,80,000, PV factor at 5% is 0.907 and present value is 2,53,960. Then for the third year, the cash flow is 5 lakhs, certainty equivalent is 0.60, adjusted cash flow is 3 lakhs, PV factor at 5% is 0.864 and the present value is 2,59,200. So, thus the summation of this gives us the net present value, which is equal to 41,640. Now, recommendations. First one, project A should be accepted since its net present value is higher than that of project B. Then project B is riskier since certainty equivalent associated with its expected cash flow after tax, which is CF80, is lower than that of project B. Then project B, being more risky, would be analyzed using higher discount rate if risk adjusted discount rate is used. Now, next method we will see is sensitivity analysis. Sensitivity analysis, sometimes called what if analysis. It provides answers to such questions as what will happen to net present value if cash inflows are less than expected. Then what will happen to NPV if cash outflows are more than expected. Then what will happen to net present value if the project life is less than expected. Then what will happen to NPV if discount rate is more than expected. So, in sensitivity analysis, typically one variable is varied at a time. If the variables are interrelated, as they are most likely to be, it is helpful to look at some plausible scenarios. The decision makers, while performing sensitivity analysis, compute the project NPV or IRR for each forecast under 3 assumptions. The first assumption is pessimistic, the second is expected and the third one is optimistic assumption. Now, the main objective of sensitivity analysis is to find out the most sensitive factor, that is the factor having least % of sensitivity, or the factor is smaller change in which may cause drastic change in project's NPV or internal rate of return. Now, sensitivity analysis basically involves the following steps. The first step is to identify all variables which has an influence on the problem, NPV or internal rate of return, that is IRR. The second step is to define the underlying quantitative relationship among the variables. The third step is to analyze the impact of the changes in each of the variables on the NPV or IRR and ascertain the sensitivity of each factor as follows: PV of cash flow after tax minus PV of CQ, sensitivity of cash outflow into 100, which is equal to annual cash flow after taxes minus annual cash flow after taxes to match cash outflow multiplied by 100 divided by annual cash flow after tax. Now, sensitivity of payback period, which is equal to project life minus payback period divided by project life multiplied by 100. Sensitivity of discount rate, which is equal to IRR minus discount rate divided by discount rate multiplied by 100. Now, the fourth step is ranking of factor from most sensitive to least sensitive. The fifth step involves finding out the most sensitive factor, that is having least percent of sensitivity. Now, we will see an illustration on this. XYZ invested in an investment project having a cost of rupees 12,000. Life is 4 years. Annual cash flow after tax is rupees 4,500. The discount rate is 14%. Now, perform the sensitivity analysis of this project with respect to investment cost, payback period, annual cash flow after tax and the discount rate. Now, we can see the solution to the illustration. NPV is equal to 4,500 rupees multiplied by PVAF 14% and 4 years minus rupees 12,000, which is equal to rupees 4,500 multiplied by 2.914 minus rupees 12,000, which gives us rupees 1,113. Sensitivity analysis A with respect to investment cost. If investment cost reaches to rupees 12,000 plus rupees 1,113 plus 13,113, then NPV becomes 0. Hence, sensitivity of investment cost is equal to margin divided by investment cost multiplied by 100, which is equal to rupees 1,113 divided by rupees 12,000 multiplied by 100, which gives us 9.257%. Now, the second one is with respect to discounted payback period. Now, with respect to the discounted payback period, we have the following table with us. 4 years are given to us, 1, 2, 3, 4. Cash flow after tax in the first year is 4,500. Then PV factor at 14% is 0.877. Then PV of cash flow after tax is 3,947. Then cumulative value of cash flow after tax is 3,947. Now, in the second year, the cash flow after tax is 4,500. Then PV factor at 14% is 0.769. Then PV of cash flow after tax is 3,461, and then cumulative value of cash flow after tax is 7,408. Then in the third year, CFAT, that is cash flow after tax, is 4,500. Then PV factor, that is present value factor, at 14% is 0.675. Then PV of cash flow after tax is 3,038, that is in the third year, and cumulative value of cash flow after tax is 10,446. Then finally, in the fourth year, we have cash flow after tax is 4,500 again. Then PV factor at 14% is 0.592. Then PV of cash flow after tax in the fourth year is 2,664, and cumulative value of cash flow after tax is 13,110. So, we can see that discounted payback, which is equal to 3 years plus 12,000 minus 10,446 divided by 2,664. Now, discounted payback is equal to 3 years plus 12,000 minus 10,446 divided by 2,664. For 3 years plus 1,554 divided by 2,664, which gives us 3.58 years. So, thus margin is equal to project life minus payback period, which is equal to 4 minus 3.58, which gives us 0.42. So, sensitivity of payback period is equal to margin divided by project life multiplied by 100, which is equal to 0.42 divided by 4 multiplied by 100, which is equal to 10.5%. Then next we will see with respect to annual cash flow after taxes. Now, annual cash flow after tax to match PV of cash outflows, which is equal to PV of cash outflows divided by PVAF, that is 14% and 4 years, which is equal to rupees 12,000 divided by 2.914, which is equal to 4,118 margin, which is equal to rupees 4,500 minus 4,118, which is equal to rupees 382. So, thus sensitivity of cash flow after tax, which is equal to margin divided by annual cash flow after tax multiplied by 100, which is equal to rupees 382 divided by rupees 4500 multiplied by 100, which is equal to 8.49%. Now, next we will see with respect to discount rate. Now, calculation of IRR, which is equal to 12,000 divided by 4,500, which is equal to 2.667. Then PVAF at 18% and 4 years, which is equal to 2.690. PVAF at 19% 4 years, which is equal to 2.639. IRR is equal to 18% plus 2.690 minus 2.667 divided by 2.690 minus 2.639, which is equal to 18% plus 0.023 minus 0.051, which is equal to 18.45%. Now, margin is equal to 18.45% minus 14%, which is equal to 4.45%. Now, sensitivity of discount rate is equal to margin 1 discount rate multiplied by 100, which is equal to 4.45 into 14 multiplied by 100, which gives us 31.79%. Now, ranking of factor from most sensitive to least sensitive. See, there are 4 columns given to us. In the first column, we have sequence, then factors, sensitivity and rank. First one, the annual cash flow after tax sensitivity is 8.49% and rank is given as number 1. Then for B, investment cost 9.275% is the sensitivity and it is ranked as number 2. Then discounted payback period, the sensitivity for this is given as 10.50 and the rank is given as number 3. Finally, we have discount rate. Then for sensitivity given is 31.79% and it is ranked at number 4. Hence, annual cash flow after tax is most sensitive area, since a smaller change in cash flow after tax may cause drastic change in net present value. Now, we will see merits of sensitivity analysis. The first merit is it evaluates risk in capital budgeting decision. Second one is it gives greater visibility to the weak spots in an investment. The third merit is it reveals how different variables are sensitive to NPV and it helps in identifying the critical variables. After knowing the critical variables, the decision maker can explore the possibility of how the variability of these critical variables may be controlled. Then the fourth merit is it helps management in proper decision making. Now, we will see demerits of sensitivity analysis. The first demerit is it considers only one variable at time and other variables are kept as constant. The second one is it does not consider the probabilities associated with occurrence of different value of variables. The third one is it is not a risk measuring or risk reducing technique. Premier Industries Limited has prepared the following budgeted profitability statement for the current year operations. Sales 2500 multiplied by rupees 4 which is equal to 10,000. Variable cost given to us, the first variable cost is materials which is 4,000, labor is 3,000, the total of this is rupees 7,000. Then contribution is 3,000 and less fixed cost 2,000. So, thus profit we can see here is 1,000. Make a sensitivity analysis on the data given. Now, the solution for this, the changes in the sales revenue and cost on profit can be analyzed with the help of sensitivity analysis as follows. First one, if selling price is reduced by more than 10% budgeted, the company would suffer a loss. Second one, if sales are reduced by more than 10% of the budgeted sales of 2,500 units, the company would suffer a loss. Then third one, if labor cost increases by more than 33.33% above the budgeted, the company would incur a loss. Then fourth is if material cost increases by 25% or of the budgeted cost, the company would make a loss. Then fifth is, if the fixed cost increases by more than 50% of the budgeted fixed cost, the company would incur a loss. Then if we observe the sensitivity of the data given, sales units and selling price per unit is more sensitive than other items of cost. Hence, this area remains careful consideration. Now, let's take a quick look at what we have discussed today. We have discussed about the risk and uncertainty in capital budgeting. Risk in capital budgeting can be incorporated by two methods. First one is non-mathematical methods and the second one is mathematical methods. Now, under non-mathematical methods, the risk factor can be incorporated by the following method. The first one is risk-adjusted discount rate approach. Second one is certainty equivalent approach, and the third one is sensitivity analysis. Under mathematical methods, risk can be incorporated by the following three methods. The first one is probability distribution approach, second one is decision tree approach, the third one is simulation approach. So that is all for today. Hope you have understood various non-mathematical techniques of incorporating risk in capital budgeting. So we will discuss part 2, that is mathematical techniques, in the next episode. Till then, take care. Goodbye.